The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to another Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services and financial planning services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of. This is a great benefit. Our AXA presenter today is Alex Bianco, Advisor and Vice President from the Western New York area. Now, before we get started, please note that all participants are muted during this session, but we will have some Q&A time following the presentation. So if you have a question, just type it in your question panel and we'll collect those, and we'll open up the dialogue and Alex will answer those questions at the end of the session. We're also recording this session, and all registrants will receive a copy of that recording, and it will be posted on the Saney's website. So with that, I'll turn the presentation over to Alex.
Great, thank you very much. Welcome everybody. Good afternoon. We're going to be hitting on a couple of topics today in regards to investments and volatility with the markets. The four topics we're going to hit on are going to include putting market volatility and risk in perspective, identifying some practices that can make a difference for you in good times or in bad, using risk management strategies to help protect your investments, and then some suggestions here moving forward for some potential next steps to take. And to start off today, what I'd like to do is just go through a very, very brief investment 101. So this will just hit all of the different areas that someone can have their money invested in, things like 403B plans, 401ks, even non-retirement accounts out there. This will just cover all of those, and we'll talk about the relationship between these different areas of the market, returns that should be seen, and then the risk that comes along with these areas as well. So I'll run through this very quickly, but the first main area here is cash. So we know that we're not really going to lose the money that we put into cash types of investments. These are checking accounts, savings accounts, CDs, money markets, basically anything you see when you walk into a bank. With that said, though, we're getting a very, very low interest rate right now. And if we were to compare that to inflation or the cost of goods going up each and every year, the money that's in these accounts generally do not even keep up with inflation, at least at this stage of the game. But we do need these accounts. We need somewhere to receive our paychecks into, somewhere to pay our bills from, and hopefully have some sort of emergency reserve account there on the sidelines for when life throws us those curveballs. When we look to get a little better rate of return, we look to the bond world. With that, we do see some fluctuation. In the recent past, we've seen somewhere between this 4, 5, 6% rate of return. But right now, it's definitely an area to keep our finger on the pulse with. With all of these different types of bonds that are out there, they do react differently as interest rates change. And as we all know, with interest rates right now being all-time rock bottom low, there could be some negative impacts on these funds that invest in specifically government bonds, which we see in retirement accounts sometimes. This is just the U.S. government loaning, money to investors for 10 years and paying the 2% interest per year. There's municipal bonds. If the city of Buffalo wants to build a new road system, they can issue bonds to do that. Corporate bonds, international bonds, high yield bonds. Really, though, the purpose of this is just to go through and see that there are many different areas within this bond investment world that someone can have their money. It could be all these different types of bonds, and they can be either short-term or long-term in time frame. And then when we look to get the best rate of return, we look to the stock market, and that's where you start to see some of these peaks and valleys come into play. We'll talk about the power of diversification here and sticking with things and just momentarily. But within the U.S. stock market, we have our large, medium, and small-sized companies, and they could be either value or growth in nature. So a large growth company would be like an Apple, Google, Amazon, huge companies trying to grow their stock price as big as it can be. Value companies are a little bit more of these dividend-paying companies here. And then we have our international stocks as well. So going through these three main areas, cash, bonds, and stocks, there's a different sort of risk that comes along with all of them. Obviously, with the stock market, there's the peaks and valleys that come along with it. I think there's a risk, though, that we could say in cash, that we're not earning anything whatsoever, and in fact, losing purchasing power every single year, that our money is not even keeping up with inflation here. So now that we kind of have an idea of all the different areas that we can have our money invested, we'll put that into perspective here with some risk and potential reward scenarios. But I'm going to ask everyone a question, and just in your mind, if you can kind of just either mentally take note of this or jot down the answer. But if we were to rewind the clock 20 years, so going back from 1998 to 2018, if somebody put $100,000 in the stock market, even through two major downticks, and we'll even say a half a major downtick at the end of 2018, that person, if they just stuck with that $100,000 in the market, at the end of 2018, they would have $410,000. Now, if you were to take away the 50 best trading days of those 20 years, which equate to about 1% of trading days, days that the stock markets are open, so not weekends, not major holidays, but taking away the 50 best days in the market, what would you think that that person would have? So started with 100. If they were in the market every single day, they'd have 410,000. But if they missed just 1% of the trading days, the amount of money that they would actually have in their account goes down to, just clear this off here, it goes down to $48,000. So it's so important to have a game plan in place and know that there is volatility when it comes to investing. Everyone's situation is different. I would imagine that there are some people on the phone call right now that, maybe earlier on in their career, there may be some people that are approaching retirement, and there may be some people that are in retirement. It's just going through this process and having a plan and understanding that there will be some risks involved in all of those different areas that we talked about, including cash, but we have to know the rhyme and the reason of what we're doing. So we look at here moving forward just a couple statistics in regards to volatility with the markets here. This the heavy cost of market timing, that's sort of what we just talked about there, but it's so important to understand that when we look at the stock market on an annual basis, there is a better chance than not. So there's an over 50% chance that at some point throughout the year, we'll turn on the TV and see that the stock market is down year to date. So from January until whatever day we turn on this TV, at some point there's going to be a negative double digit there, more times than not. It's just a matter of what do we do when that happens. And if we're the type of person that we just cannot see our accounts decline in value ever, then maybe we shouldn't be invested in that area. But if we have some time on our side, we can certainly see a little bit of fluctuation there, especially if we're contributing to these 403B plans for the fact of as these markets are going up and down, we're consistently putting money into our retirement account, which means we're buying in at low points in the market as they take downticks along the way. Moving forward, volatility is normal. Again, don't let it derail you. That double-digit number out of the last 39 years, we've seen it 22 out of the last 39 years. But at the end of the year, 75% of the time, the markets have been up. So it's completely normal to see volatility. Again, it's even more normal than not to see a double-digit decline in the stock market from January until at some point throughout the year. But there's a different story when it comes into retirement, right? So, I've been, talking about this scenario of markets going up and down and we're contributing into our retirement accounts. It's very, very important, though, as we approach retirement, we'll say these 5 years pre-retirement, 5 years post-retirement, to try to not see major declines in our accounts. So we're going to jump now to identifying practices that can make a difference here in good times or bad. But the reason I'm bringing this up is, and I'll get back to our full screen mode here, if we were to take a look at Mr. Green here, this is a person that retired at age 65 with $1 million in their retirement account. They retired in a good starting point here where the markets were up. This would be the market return. Markets made 5, made 28, made 22, lost 5, lost 20. At the end of the day, all of these returns for a 25-year time frame here make up an average of a 6% rate of return. So that $1 million turns into $4.288 million at the bottom. But the interesting thing is when we take a look at the next slide, we can look to Mr. Blue here on the right-hand side. All that is different is Mr. Blue retired in a downtick in the market. So we actually just flip-flopped all of these numbers. The +5 is now at the bottom for Mr. Blue. The -25 is now at the top for Mr. Blue. They're just completely flipped around. At the end of the day, though, they both still have the same amount of money because the average rate of return was 6%. Here's where this becomes very, very critical. And this is if we were to look at somebody actually now taking money from their retirement accounts, because generally that is a main reason of why we save into them. Mr. Green, who retired in an up market with some good years to start off, was able to take $50,000 every single year. And then at age 90, he still had $2.5 million with, again, that same average 6% rate of return. Mr. Blue, though, happened to retire in a down sort of year or 2 or 3 here, as you could see in the markets. And as he is pulling the $50,000, we start to see now the account value decrease dramatically. And he actually runs out of money at age 83. So as we're talking about volatility or fluctuation with the markets, again, it's normal, it's okay to see. It's not the end of the world if we have a long time frame before we start to access this money, especially if we're putting money into these plans. But what we don't want to see is a scenario where someone does have a very nice nest egg saved up and they just happen to retire at the wrong time. And I would imagine that's on everyone's mind who's getting close to retirement right now. Not sure if this exact sort of scenario played out in their minds here, but hey, we know we've been on this great run in the stock market, right? We've been on this 10-year historic run, and at some point, yes, it will end, but nobody knows when that's going to happen, or nobody knows how bad it will actually be. But there is definitely value in having a plan in place. And if we're able to, have this plan of a person or a family, a couple, that is retiring and there's one pension or potentially 2 pensions out there, it's a little bit different of a story than someone who does not have any sort of pension income. Generally, someone retires from a for-profit company with no pension, and they have to start accessing their retirement accounts day one to live. Whereas pension holders, they get this great pension as soon as they retire. It has a decent cost of living adjustment, but that doesn't kick in for a handful of years at least. And it's usually these 403Bs that we're talking about with the account balances here. It's those types of plans that bridge this gap as our pension and Social Security kicks in, but we're really not getting too much of a pay raise with those. But our bills are getting higher. It costs more to go to the grocery store. Every day is now a weekend rather than going to work 5 days a week. So there's a lot more time to be spending our assets. But people with pensions have a little bit of an advantage that they can potentially hold off to access their retirement accounts. So using risk management strategies to help protect investments, this is something that we've been doing a lot within the school districts here in New York State. Whether it's with administrators, faculty, staff, transportation departments, it truly doesn't matter. But one of the great features that AXA has, and this is very specific to AXA, no other 403B offers this, is the ability to be invested in the markets but have downside protection if things don't go so well. So I'll come back to this really quickly, our investment 101. If we were just to look at these large companies here in the United States, both value and growth in nature, this really makes up the S&P 500. So that's like the benchmark for large investments here in the US. It's the 500 largest companies that we have. We're able to invest in mutual funds that hit these areas, whether it's through T. Rowe Price, Oppenheimer, Fidelity, you name it. You know, we have those abilities, and all the other providers through the districts do as well. But there's a feature that AXA has in the 403B plans that is so beneficial right now to still take advantage of good things that could come in the market. And there are definitely still some indicators out there that, you know, there is still some room to grow. Just like a lot of the statistics show that many people, individuals, families have been holding on to a lot of cash investments right now, whether it's in the bank or whether it's in money markets or guaranteed interest accounts in their 403B plans. Companies are also in that same sort of line. The reason is a lot of these big companies here in the US, let's say, they have so much money, an historic amount right now, more than ever, sitting in their savings accounts. And really what they're doing is they're waiting for some more solid rules to be established. So hopefully the CEOs, who are very smart people, will make decisions to allow that company to make profits. So they have all this money sitting there. They just don't know, hey, do we want to go buy our competitors and help our bottom line? Do we want to go buy our suppliers and streamline our business? Do we want to build more plants and hire more people? They're just waiting for a little more solid types of rules to be in place for them to make those decisions with. And when they make those decisions, hopefully, again, they're decisions that make money for those companies, in turn make money for the markets here in the US. But with that said, we know also we're at this very high point in the market, and we do want to be protective of some of our assets here. So I'm just going to give a quick example of, again, now we talked about this S&P 500, which is the 500 largest companies here in the US. There's the ability to be invested in the S&P 500 either right within an AXA 403B or within an individual IRA out there, potentially from an old organization, or maybe it's a family member has an outside retirement account. This can be done where someone can be invested in the S&P 500. So it's right there in the S&P 500, the benchmark of the US stock market. It's not in a mutual fund managed by T. Rowe Price or Fidelity that may or may not keep pace with the S&P 500. But the critical piece on this is all of these columns here, the -10, -20, -30, that is a layer of downside protection. So just this example means that somebody can be invested in the S&P 500 for a 5-year time frame. If the S&P 500 drops anywhere from -1 to -20, they do not lose 1 penny of their investment. There's a pro and con to everything in life, in every account out there. I just mentioned all the pros. Of course, I'll have to hit on a con if we can look at it even as that. But to have that downside protection, it means there's a maximum amount that you can make throughout that time frame. So in this scenario, we can be invested in the S&P 500 for 5 years. If the markets go down, we're protected on the first 20% of declines, and we can still average an 8% per year rate of return, 40% over 5 years. If we want to get a little more protective, the only difference now is with this 30% downside protection, the maximum amount that you can make throughout that time frame, it just goes down. And this is an alternative that we're using with a lot of our clients right now for the conservative parts of their investment accounts. Because again, I think we all know what we're getting in our checking and savings and money market types of accounts. If we can put a 30% layer of downside protection, meaning again, markets go down by 25, we walk out of that 5-year time frame exactly even. If they go down by 35, we walk out of that 5-year time frame only losing 5% because we're protected for the first 30% of the clients. But then there's a maximum of, again, of this 27%. I would love to see that maximum have to be cut off, right? So the markets go up over 5 years by 30, 35, 40, whatever the number is, somebody gets still 27, and it's done on their very, very conservative part of their account. That could be a lot better than having our money in money markets right now, because we know what we're getting right now, and we'll just call it pretty close to zero. So we know what we're walking out of that 5-year time frame with in that area. I would say we have a pretty good chance to, worst case scenario, walk out of the 5-year time frame over here in the same exact place. Markets go down by a lot. We walk out of there exactly even. But at least we have a chance to make some money over those 5 years. So this could be done through the S&P 500, again, the large companies here in the U.S. There are other areas as well where we can hit on the medium and small size companies in the U.S. What that is the Russell 2000. So that's just the benchmark for those types of companies, the small and medium sized companies. And then the MSCI EAFE here, that's an international stock market index. So this is the way to be invested, right, either with your 403B through whatever school district you're a part of. Inside of an AXA 403B, this is available. It can be done in traditional IRAs, Roth IRAs, things that usually are used after somebody does get into retirement. But it does two things. It allows us to continue to make money when markets go up, and it allows us to be protected in one way, shape, or form with different levels of protection that we would talk about to either get our money back or lose less than we would have had we not had the downside protection. So it's a strategy that it does one of two things. Either we make money, we get our money back, or we lose less than we would have. And the key part about really everything that we're going through so far today is that everyone's situation is different. Just like everyone's pension is different. It's based off of your age, it's based off of years of service, income, potentially those reductions that are built in are based off of a spouse's age there. These do not have to be a one-size-fit-all sort of account out there. Really, they need to be looked at with everything else. And the strategy we're talking about right now, it could be used as a portion of someone's retirement assets. It could be used for all of them. It just depends. So the next step, for everybody on this call is really to get in touch with somebody that has this information at their fingertips. It can certainly be myself. If you're not in the Western New York area, I'm more than happy to direct you to one of our representatives and advisors in the area that you're in. I'll also be happy to answer any questions that you have either at the end of the call here, which we're wrapping up with, after the call, or in the future at any point in time. But it's meeting with somebody and building out a retirement plan. So when we're still working our whole entire lives, it's based off of when we're talking about investments, it's based off of our saving strategy. How much money are we putting in? How is it saving us money on taxes? Where are we investing our funds? But as soon as we get into retirement, the strategy changes. And it's not a savings strategy anymore. It's either a protection strategy to protect what it is that we've built, or it's our distribution strategy. How are we going to best access these funds when markets are good, when markets are bad? Should we be pulling them from different places within our retirement account assets? The short answer is yes, but we do want to make sure that we're meeting again with our clients and that clients are meeting with advisors, very honestly, whether it's us or anybody else that you're working with, to build out these retirement plans and get this game plan in order of how long do we have until retirement? What is it that we're going to need in retirement to keep the standard of living that's important to our household? And moving forward, what can we do to protect what it is that we've built, especially after we're coming at the end of this? I shouldn't say at the end of it because it still is going on, but we're through this great 10-year run at this point in the markets. And again, the last thing we'd want to see, going back to Mr. Green and Mr. Blue there, is someone to retire, the markets take a huge drop, they take a bunch of money out of their retirement accounts. At the same time, it makes it very, very hard to get back to even. And the other thing we don't want to see is everyone sitting in cash because we're not even keeping up with the cost of goods that rise in price every single year with inflation. So there's a happy medium. There are different ways to plan for all these different things we talked about. This is one specific example that I just went over here today with everybody, but it works very, very well, again, to make money when markets go well and to protect what it is that we built when markets do take that downturn there. And it makes us not have to make the decision, well, what do we do now? We just lost a bunch of money. Do we get out of the markets? Do we get in the markets? Do we double down and put more money in? By using a strategy like this, that question doesn't even need to be asked. So it doesn't require an answer. So that wraps up for today with some suggestions, potential next steps there. Again, we'd love to be a resource across the state for everybody. We work hand in hand with Sainies. We're happy to always answer questions. Come out to your school district. You're welcome into your respective offices within AXA across the state at all times. So I'll turn it back over. And I think we're going to have a little bit of time to take some questions, if that still sounds good, Michelle?
Yeah, we do. Right now, I don't see any questions in the question panel. So we'll just give that a minute. If these are more personal in nature, like Alex said, you can reach out to Alex or the AXA advisor in your region. And if you go on the Sainies website, and I'll email this to all of you, but if you go to resources, there's a whole AXA section. It says AXA services, and you can find the page there. It says find an AXA advisor. So certainly you can follow up on all this content on a more personal level with an advisor. And again, take advantage of, oh, look at you go. Alex is putting his phone number right up there. That's great.
If anyone does have any questions that they may even not want to ask right now over the line here, feel free. I'm going to actually be in my office right at my computer at least for the next half hour. So if there is anybody that does have a question, feel free to give me a ring. But thank you, everyone, for joining us today. And Michelle, I'll let you wrap up here if there's no questions.
Yeah, I think that's it. So perfect. You have Alex's phone number there, and we will email you a recording of this session for follow-up. So until next time, have a great weekend, everybody. Bye-bye.
Bye, everybody. Thank you.